Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. You're not alone if the news around the Federal Reserve lately has been confusing. One week, an analyst is on TV confidently predicting 3 rate cuts by the end of the year. The next week, a new inflation report comes out, and suddenly those same experts are talking about rates staying higher for longer. It feels impossible to get a straight answer. But what if I told you there's a tool, a kind of secret map, that the Fed itself releases, showing us where the most powerful people in finance think rates are heading? It's not a guarantee, but it's the closest thing we have to a crystal ball, and it's something every serious investor needs to understand. Today, we are demystifying one of the most obsessed over pieces of financial data, the Fed's Summary of Economic Projections, better known as the dot plot. We'll cover what it is, where it came from, and most importantly, how you can use it to make more strategic real estate decisions. So, what is this mysterious chart? Imagine you get all 19 top officials of the Federal Reserve, the presidents of the regional banks, and the board governors into a room 4 times a year. You give each of them a piece of paper and ask them anonymously, where do you believe the federal funds rate should be at the end of this year, and the next year, and the year after that? Each of their answers becomes a single dot on a chart. That chart is the dot plot. It's that simple. It is a visual summary of the private opinions of the people who actually vote on interest rates. Now, it's crucial to understand what the dot plot isn't. It's not an official promise. It's not a binding commitment. It's a forecast, and like any forecast, it can change based on new economic data. The real power isn't in any single dot. It's in the median dot, the one right in the middle. The median represents the consensus view of the committee. When you hear the news report, the Fed is projecting 2 rate cuts this year. They are talking about the median dot on that plot. It's a powerful signal of the Fed's collective thinking. The dot plot is a surprisingly recent invention. Before 2012, the Federal Reserve was famously opaque. It was a financial black box. The chairman would issue cryptic statements, and Wall Street would spend weeks trying to decode the Fed speak. This created a lot of volatility because the market was constantly trying to guess the Fed's next move. Then, in January 2012, Fed Chairman Ben Bernanke introduced the dot plot as part of a radical push for more transparency. His point of view was simple. If the Fed could give the market a clearer picture of its own expectations, it would reduce uncertainty and lead to more stable financial markets. He wanted to give investors a roadmap instead of just letting them wander in the dark. It was a revolutionary idea. For the first time, the Fed was showing its work, giving us a glimpse into the internal debate and the likely path of future policy. It transformed the Fed from a mysterious institution into one that, while still complex, was far more understandable. Okay, so it's a forecast from a bunch of economists. Why does it cause the stock and bond markets to swing so wildly? Because, as we discussed back in episode 78, your mortgage rate has a very close relationship with the 10-year U.S. Treasury note. And the 10-year Treasury, in turn, is incredibly sensitive to expectations about what the Fed will do. The dot plot is the clearest signal of those expectations. Let's break it down. If the new dot plot is hawkish, meaning the dots are higher than the market previously expected, it signals that the Fed is more worried about inflation and intends to keep interest rates higher for longer. The bond market reacts instantly, Treasury yields often rise, and that puts upward pressure on mortgage rates. If the dot plot is dovish, meaning the dots are lower than expected, it signals the Fed is more confident about inflation and is leaning towards cutting rates. Treasury yields often fall on this news, and mortgage rates tend to follow suit. For real estate investors, this is the direct transmission mechanism. The dot plot gives you a vital clue about the future cost of capital, the money you'll need for your next acquisition, your next construction loan, or that cash-out refinance for your BRRRR deal. This brings us to the most important part. How do we, as prime investors, use this information to our advantage? This isn't about day trading the news. It's about making better long-term strategic decisions. Here's a simple playbook. 1. For timing your refinance, are you running a slow BRRRR strategy like we talked about in episode 82, waiting for the right moment to refinance? A dovish shift in the dot plot is your signal to get your documents in order and start talking to lenders. It suggests that a window of lower rates may be opening in the next 3 to 6 months. 2. For underwriting new deals, is the dot plot looking hawkish, signaling higher rates for longer? Then you need to be more conservative in your deal analysis. Your projections for future financing costs on a variable rate loan or a future refinance need to reflect that reality. A hawkish Fed means your margin for error is smaller. 3. For market level strategy, the dot plot also tells a story about the economy. A plot with many aggressive rate cuts might signal the Fed is worried about a recession. This should prompt you to go back to your hyper-local research we hammered home in episode 34. How resilient is your target market to a potential economic slowdown? A stable dot plot, on the other hand, might signal confidence in the economy, supporting stable rent growth and property values. My point of view is this. The dot plot isn't a crystal ball that tells you the exact mortgage rate on a specific day. It's a strategic compass that tells you the general direction the financial winds are blowing. And that's the dot plot demystified. It's a forecast, not a fact. It's a collection of anonymous opinions, not an official policy. But it is the single best tool we have for understanding the Fed's thinking and, in turn, anticipating the future cost of the capital we need to grow our portfolios. By learning to read this map, you move from being a reactive investor confused by the headlines to a proactive one who understands the forces shaping our market. Now, your challenge today. This one is simple but powerful. Go to a major financial news website, Bloomberg, the Wall Street Journal, or even the Federal Reserve's own website, and find an image of the latest dot plot. Don't get bogged down in analyzing every single dot. Just find the median projection for the end of this year and the end of next year. See the forecast for yourself and connect it to what you're seeing with mortgage rates today. Thanks for tuning in. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.